Thank you so much for joining us today for the third in a four-part series called Bettering Your Business. And today we're talking about liquidity. And I know liquidity can be kind of a daunting or perhaps boring topic. So I thought I would start out by telling you a little bit about myself as maybe that would lighten the mood a little bit. So I am the SVP of Financial Education at Squire. We're a financial wellness benefit company. And I started my career about 20 years ago. I ended up getting a job at Citigroup, trading currencies on the trading floor. And so I would walk to work every single morning at 5:15, 5:30. I would call my mom, and God bless her, she took my call every single morning. And I would walk onto the trading floor. And truth be told, I felt like I was diving off of a diving board every single time I walked onto the trading floor. And then every time I would pick up the phone, and say, "Foreign exchange, this is Casey." And some client would scream at me from the other end of the phone, and I would then scream at a trader, and then the trader would scream back at me, and then I would say something politely to the client on the other end of the phone, and then I would do these hand signals. This meant I buy or client buys. We had this huge trading floor, and it was me and the trader eye to eye, trying to execute this trade from 20 feet apart, either by screaming or doing hand signals. And so truthfully, every single time I picked up the phone, every single time, I felt like I was diving off of a diving board. And so then I moved into another product called structured credit, which foreign exchanges or currencies is very simple, actually. You buy euro and sell yen, or you buy dollars and you sell Swiss francs, and it's considered to be a fairly simple thing to trade. Whereas structured credit is considered to be a very complicated thing to trade. So now I was trading derivatives at the top of my lungs, shouting at traders, no hand signals, but still really scary. And so truthfully, every single time for about a decade, every time I walked onto the trading floor, every time I picked up the phone, I felt like I was diving off of a diving board. So then I decided to retire from Wall Street during the credit crisis in 2009, and I had my first baby. I worked until 2 days before I had him, and as soon as I had this baby, if any of you are moms, you can attest to this, I felt like I was diving off of a diving board every single day, every day, everything I did. And just right around when I felt like I was getting the hang of things, I went and got myself pregnant with twins when he was 9 months old. So I ended up with 3 children under 16 months old, which again, not surprisingly, felt like I was diving off of a very high diving board. So I did that for a couple of years, and then I decided to start my own business. And that also felt like I was diving off of a diving board. And I'm sure any or many of you, or if not all of you, if you're mothers or entrepreneurs or women trying to just make it in this world, you probably can share that experience with me. And so then I decided that, or I got approached to merge my company, and I merged my company with Squire. Yet again, I felt like I was diving off of a diving board. And so you'll see in just a second how all of this relates to liquidity. I'm about to hammer you with so much information about liquidity in your small business. Your head might start spinning. So I thought I would start off with a little bit of a lighthearted concept of, look, this is really hard what we're doing. I don't know what your businesses are, but it's hard. That I know. I've done it. I've been there. I'm an entrepreneur. I'm a mom. I'm an employee. I'm a woman. It's hard. And I feel and felt like I was diving off of a diving board many, 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 many times over the course of my career. And yet, to be honest with you, every single time I start doing one of these talks, I feel the same way. I feel that way right now. I feel nervous, and I feel like I'm cannonballing off of this really high diving board. And so how does this relate to liquidity? Well, I'm going to share my screen if I can find it. And I'm going to show you. So can everybody see that? Deborah, can you see that? Okay, great. So once again, welcome to Bettering Your Business, Assessing Debt and Liquidity Options for Your Business, Even During a Pandemic. Such a lovely title, nice and long. So yes, we're talking about liquidity, kind of a difficult and perhaps a little bit boring, and a topic that most people don't spend a lot of time talking about. We're going to try to have a tiny little bit of fun with it, and really, truly, we're going to talk about this diving off of a diving board thing. So just to plug our last and our or the previous and the last talks. Again, this is the third in a 4-part series, Bettering Your Business. A few weeks ago, about a month ago, we talked about wealth building in your personal financial, in the realm of personal finance. That talk is up on the ODU Women's Business Center YouTube page. A couple of weeks ago, we talked about managing debt, prioritizing debt, different types of debt. That's also up on the ODU Women's Business Center YouTube page. Please go back and take a look at those if you're interested. Today, we're talking about assessing debt and liquidity options for your small business. And then in a couple of weeks, on Wednesday, April 28th, we'll be talking about COVID-19 resources available. So please consider joining us for that. Okay, so let's get started. What are we going to cover today? We're going to cover 3 things. What is liquidity and why is it so important? Why should you care? Then we're going to talk about 5 tactics you can and should be considering when it comes to managing and maintaining your liquidity for your small business. And then finally, the most important thing you can do for your small business in the realm of maintaining and managing liquidity. Of course, there are lots of important things we should be doing for our small businesses. Today, we're just focusing on liquidity. So let's get started. What is liquidity and why is it so important? Well, technically, liquidity is the ease in which you can convert financial assets into cash. It's the ease in which you can convert financial assets into cash. I like to think of liquidity like a glass of water. We all have businesses, I assume, and all of our businesses are different. So your business might be very liquid. It might be full of cash or water, or you might have assets or inventory or equipment or vehicles or real estate, buildings, some other things that are assets, but not liquid assets like cash. And so the size of your ice cube is sort of what we're relating to your asset. You might have this huge building that would be really hard to sell and that is critical to the running of your business. That asset or that ice cube could take a long time to melt. That is not super liquid. That would be considered less liquid. Or if you had things like inventory on your shelves that you could potentially sell tomorrow if you had to or wanted to, perhaps if you discounted them by 25%, they would fly off the shelves. Those would be considered pretty liquid. So real estate might be a huge ice cube and inventory might be considered an ice chip or a shaving of ice that might melt into liquidity in a day or 2 days or a week or a month or something. So there are different ranges of liquidity. And of course, we all have different needs for different amounts of liquidity in our businesses. So I can't speak to your specific businesses, but we're going to talk about liquidity as a general concept. And again, 5 important and critical tactics that you can potentially consider using in order to increase liquidity in your building. So in your business. So again, we're here today to talk about liquidity broadly, but we're going to talk most specifically and spend most of our time talking about these tactics that you can and may consider using to increase liquidity in your business. And so again, just visually, I want to remind everybody, we all have different amounts of liquidity needs, and your liquidity needs could change over time. You could have a cyclical business or a seasonal business. You may, the problem or the issue with cyclical or seasonal businesses is that your revenue might go like this, whereas your costs go like this. You still have to pay your rent, still got to pay your salaries, still got to pay your taxes. And so if you have revenue that's going up and down over the seasons, you want to make sure that you maintain enough liquidity to be able to pay all of those liabilities that you have. You want to make sure you have enough water in your beaker that you can pour it into all of the other little beakers that are empty and are screaming for you to fill them up. So your business may feel like you need 3 months of liquidity to make you feel comfortable, or 6 months of liquidity to make you feel comfortable. I don't know what that number is for you. And again, it may change over time, may change based on your risk tolerance or the way your business goes, but you want to be aware of both micro things that can happen that might need you to increase your liquidity, like you not being able to work for a period of time, or macro things like perhaps the global pandemic. So you want to be considerate of all of those liquidity needs. So why do we care about liquidity? Tell me why it is so important, Casey. Well, there are lots and lots of reasons why it's important. I would say the top three that I have come up with are credit worthiness. So if a lender is looking at you and thinking, shall I lend this company some money? They're going to look at your company and say, are they credit worthy? Will I get my money back? And so they're going to be thinking about and looking at your liquidity as a measure that you currently have, but also having had liquidity in the past will have allowed you to pay all of your bills on time. So liquidity is really important when it comes to credit worthiness. Liquidity is important when it comes to emergencies. Again, as I was just mentioning, if something happens, like you break your leg, or you have a lawsuit, you get hit with a lawsuit that was unexpected, or you lose your best client, or you land yourself in the hospital, or your equipment breaks down, or any of these tiny little, not tiny, I take that back. Any of these things that happen to you specifically that make your business less efficient, let's say, you want to have liquidity to make sure you deal with those. There are also global, macro, national, cyclical, economical things that can happen to us broadly as a country, as of course we are all very well aware of now. So you want to make sure that you have enough liquidity to make it through to weather those storms, big emergencies or macro emergencies and micro emergencies. And then finally, liquidity is important so that you can make smart financial decisions. What does that mean? Well, what if you see this really, really smart person that you know would fit into your business perfectly and will increase your revenue 2-3x? You want to be able to hire this person, but it might take 3 or 4 months for them to start actually increasing the revenue. If you have liquidity, you may be more apt and able to hire that person. If you see another business that you know will be a perfect synergy with your company and you want to maybe buy that business, if you have liquidity, it will allow you to make that smart strategic financial decision. Or again, if you have a cyclical or seasonal business, let's say you have a seasonal business and you do most of your selling in the winter, and in the summer you see this inventory that comes on the market for half the price and you want to buy it, but you don't necessarily have the cash on hand to buy it, yet you know you'll be able to sell it and make 2 or 3 times what you paid for it in the winter months. Well, having liquidity will allow you to make smarter, more strategic financial decisions. So that's why liquidity is important. I want to bring us all back to high school or college accounting, if you even took that, just for a brief second, I promise, to talk about where liquidity lives and who looks at it and how it's measured and stuff. And that liquidity is typically measured on your company's balance sheet. And I'll just remind you, a balance sheet is a snapshot in time of your assets and your liabilities. It's a moment in time of how much money your company has in assets and how much it owes in liabilities. And so your balance sheet is broken up into 4 segments, sort of. It's broken up into a top and a bottom, which is current, which means short term or less than a year typically. And then in the bottom half, it'll be long term, so greater than a year. And then on the left side, you'll have your assets. On the right-hand side, you'll have your liabilities. Let me show you exactly what I mean. So all of these things are listed in order of diminishing liquidity. So on the top left, you have your current assets. Cash is, it's the most liquid thing you have. You can use cash to buy things, of course, right away. Accounts receivables might be not inventory, invoices that you have that you are waiting for people to pay on. That's a little bit more liquid. It's more likely to turn into cash quicker. Inventories are the same. Now your balance sheet might look different from mine or the person next to yours, but all of your assets will be ordered listed in order of diminishing liquidity. I'm not going to talk much about liabilities. We talked about that a lot in our last talk. But on the asset side, you'll then have non-current assets. And again, you'll see these listed in order of diminishing liquidity. So a vehicle, could you sell that? Yeah, probably. Can you sell your plant and equipment? Yes, you can definitely sell it, but how long it would take and how much money you would get for it and whether or not you would be able to run your business without it, that's another thing. Real estate, again, ordered in listing of diminishing liquidity, and then non-current liabilities. So these are long-term loans. I didn't spend too much time on that. And then at the bottom of your balance sheet, it lists your net worth. So this is your assets minus your liabilities. So that's sort of where liquidity lives. I shan't say enough anymore about balance sheets because they just make everybody's eyes cross. So here we are at this diving board analogy that I opened up with. So you see what I did here with the pool on the bottom, liquidity. You have to try to make this stuff a little bit entertaining. Well, I tried to anyway. So you'll see here, we're going to talk about these 5 tactics. And we're going to spend the bulk of our time talking about these tactics today. And you'll see that these diving boards are getting increasingly higher as you go on. And so first, we're going to talk about reducing costs. We're going to make our way up from 1 through 5. And finally, we'll talk about equity raising investors, bringing partners in. And so number 1 is your least expensive way to manage and maintain liquidity. And we go all the way to 5, which is the most expensive way to maintain and manage liquidity. And so you're going to see, and don't worry, I will highlight this to everybody when we get there. But right around number 3, payment management, is when we start to talk about things that get pretty expensive. So I want to be super, super clear about this. There are some things like reducing costs that we should all be doing without any question. Banking services, also we should be doing those and using those. Right around payment management, and again, I will highlight this to you and make sure nobody's multitasking and they see exactly what I'm talking about. There are some things that might look like great deals and ways that you can maintain and manage your liquidity that also can be very, very expensive if you read between the lines. And then of course, finally, equity raising and investors is probably the most expensive way, but we'll get to that in a couple of seconds. But I wanted to make sure everybody understood that we are talking very, very specifically in order of expense, of getting more expensive. Creating and maintaining liquidity can be very expensive. All right, so let's talk about all of these 5 things. I didn't mention this, but if anybody has any questions, I will absolutely hang around at the end to talk about them. I will also give you my email address at the end so we can talk about them if you want to talk privately. But if you have questions or experiences with any of these things, please feel free to take yourself off of mute and share with us if you decide that you want to. So this is an open forum, even though I know I'm talking 50 miles a minute. So reducing costs, let's talk about that for a second. And again, these are things that we should all be doing in our personal life and in our business life. There are ways to increase liquidity, and one of those ways is to decrease the amount of money that is going out of our bank account. And so the less you spend on things like rent and ongoing expenses, that gives you more liquidity. And so if there are any ways that you can negotiate your ongoing costs lower, either by going digital, getting rid of real estate, all sorts of different ways. Again, it's hard to tell. Everybody has such different businesses in this group. Reducing costs and again, rent and ongoing expenses is a great way to increase your liquidity. Subscriptions, again, this goes for us personally and professionally, or except definitely for me. Subscriptions, we spend so much money on subscriptions these days. It's always a good practice to just every quarter, every year, sit down, list them out with your business partner, with your life partner, with your kids, whatever it is. We spend a lot of money on subscriptions, and $5 a month going out the door every month doesn't seem like such a big deal, but at the end of the year, it can feel like a big deal, especially if you have 2 or 3 of those subscriptions. So it's always good to just do a gut check on those a couple of times a year. Insurance is also a really important thing to think about. Of course, I'm not suggesting you get rid of insurance, but shop around, make it a once a year thing. Shop around, see if you may perhaps want to increase your deductible and reduce the amount that you're spending on your insurance every year, if that's appropriate for you. You want to consider all of the costs that you're paying on an annual or quarterly or monthly or weekly basis, and try to just keep on top of them and make sure that you're not paying more than you should be paying. Professional fees. These can be so wide ranging. Coaches, accountants, cleaners, CRMs, what does that stand for? I can't remember. The relationship management software, CRMs can be very expensive. Publications, apps, research, tech services, website hosting, all of these fees that we pay for. Of course, many of them are really critical to the running of our business. Just make sure you shop around, make sure you're aware of them, make sure you're not overlapping anything. You're getting something with your CRM that you're also paying for in another place. Just be aware of all these costs that are going out every month. And then finally, salaries and employees. This can be a big line item on our cost, on our expense, on our income, whatever it's called, where we list our expenses. I can't remember. What's the word? I can't remember. Anyway, salaries and employees. See if you can find flexible work arrangements. If you can get a VA, a virtual assistant, that might cut the cost down, reducing your administrative expenses. See if you can do some things yourself. See if you can go digital and reduce the amount of office space you need. There's lots and lots of different things we can do when it comes to reducing costs. The idea here is to really be aware of them and on top of the costs that you're spending, so you can bring in more liquidity. Okay, anybody have any comments or thoughts on that before we move on to banking services? Okay, well, banking services. There are a lot of ways banks can offer us access to liquidity and or give us a little bit of money back in our pocket just for banking with them. So again, these are sort of in order of least to most expensive when it comes to banking services. High yield savings accounts. This isn't really applicable right now because interest rates are so super low. But in the future, if you have money, liquid money, cash money sitting in a bank account, you want to make sure that it's earning a little bit of interest. And a high yield savings account is a great way to do that. Again, high yield savings accounts these days are paying close to nothing. So I wouldn't necessarily say this is an immediate thing you can do to increase liquidity in your business, but something you should keep in the back of your mind because interest rates will eventually, at some point, go up at some point. Overdraft protection. I don't know if anybody's aware of this. This is something that I find really kind of funny that they call it this really nice name. They call it overdraft protection, which makes you feel protected, all warm and fuzzy. This is actually quite an expensive way to guarantee that you don't bounce a check. So what it is the bank will say, look, if you don't have enough money in your account, meaning the bank will either link it to another account and draw of yours and draw funds out of that so you don't bounce a check, or they will cover it themselves. They charge you a pretty penny for this. So they call it overdraft protection, which to me sounds really nice and warm and fuzzy. And then they charge you a courtesy fee, which I also think sounds nice and warm and fuzzy. But don't be fooled. This is an expensive way to make sure that you don't bounce a check. Be aware of it. Have it if you feel like it would be applicable to you and it would help you sleep better at night. Try not to use it if at all possible. Unlimited transactions. So banks, of course, charge us fees for services that they offer us. Make sure you're at a bank that that offers you the right services for the business that you have. If you're making deposits or doing lots of digital transactions, making deposits 10 times a day or 10 times a week, make sure that you are at a bank that gives you the services that you need. They're not charging you extra for the things that you need. Same thing with digital banking. This can be a super efficient way to increase liquidity if your clients can pay you straight away, or if you can pay your vendors or suppliers right away. Digital banking is a really efficient way to move money around, therefore hopefully increasing your liquidity. Getting a tiny bit more expensive towards the bottom of this list, LOC, which stands for letter of credit. Letter of credit is basically having a line of credit to the bank, so they're willing to lend to you. You want to be in a banking relationship that is able to offer you, again, the things that you need and want as a business. So you want to be at a bank that if you think you might need an equipment loan or a business loan, they are able to offer that to you. Banks typically take better care of the people that have long-standing customer relationships with them, that keep money in their bank. So the bank can, of course, use your money so they can make more money. So you want to make sure you have a relationship with a bank that actually works for you and gives you the services that you need, and also you have access to the things that you need from them, so that when you can use the leverage of your relationship and the money you keep there to help you get hopefully better rates or terms on letters of credit or loans. And then finally, and maybe this is a no-brainer to many of you, but most of the time when you have a banking relationship with a bank, a business account, they offer you credit cards. And again, this is of course the last thing on our list because it's the most expensive. Credit cards of any type of nature, as I'm sure we all know, are really expensive ways to have liquidity. So yeah, it's great to be able to buy that inventory off season on a credit card and not necessarily pay that credit card back until perhaps the summer or the winter months when we actually make our sales. Really expensive way to use liquidity credit cards. So just like with personal credit cards, they can have really high interest rates. But another one thing I wanted to say on credit cards is if you use your credit card to buy gas, or you need to go to Costco a lot, or any other number of things, you want to make sure you have a credit card that gives you the reward points for the things you would be buying anyway. So if it's 1% or 5% cash back on gas, shop around for a credit card and make sure you have the right one that pays you back a little bit for the things that you need to use it for. Okay, any questions on banking services? Thoughts, stories, anything? Okay. We're going to try to move a little bit quicker than normal because we started a little bit later and I want to try to finish on time, but we'll see if that works. So here we are on managing payments. And again, I just want to highlight, this is number 3. So we're going to talk about a couple of things, number 1 and 2, and then this is where we start to dive off of the diving board. This is where things start to get expensive. And I promise you, if you're multitasking, come back to me for just a second. This is where it starts to get expensive. So I want to make sure everybody is well aware of that, because some of these things can be complicated and they can sound really great ideas, and yet they can end up charging you a lot of money. So managing payments, again, we're going to be talking from least to most expensive in this list. One of the passive, easy things you can do to increase liquidity is early invoice submission. So you want to make sure you're getting paid for your services or your products or whatever it is that you're selling as quickly as you possibly can. You want to get as much money in the door as quickly as you can. That gives you liquidity. On the other hand, you want to negotiate with your creditors, your lenders, your suppliers. You want to have as much freedom as you can possibly muster to make your payments as late as you need. So you want to get the money in as quickly as possible, and you want to have as much flexibility on paying out as possible. Now, of course, if your lenders are charging you interest on charging interest or fees on the time that you're taking to pay them, you definitely want to make sure that you reduce the amount of time that you have interest charges accruing or fees accruing. But in theory, you want to get as much money in as possible and then try to have as much flexibility on paying out as you possibly can. Okay. Ooh, just poured water all over me. Okay, here we are at the diving board. This is the pivot. And again, I know I'm repeating myself, but I want to make sure everybody is very well aware of this pivot. Here's where things start to get expensive. So there are some other ways that you can increase liquidity for your business. The first one is merchant invoice finance. So merchant invoice finance is basically when you link your accounting software or something, let's say your payment software, up with a business. And as soon as you make a sale, that business pays you on your sale. So you make a sale for $100, they pay you $100 in your bank account, perfectly fine, liquid cash in 1 or 2 days or less. Who knows? It always depends on the business or the relationship or the contract. But you make a sale and the money plunks into your account. And then you have some period of time to pay that back. So if your customers are routinely taking a long time to pay on their invoices, you can use merchant invoice finance, a company like that will pay you right away. They then wait for you to pay them back. So it gives you flexibility. You get liquidity right away, and you have some time to extend the amount of time that you then have to pay them back. That's all fine and good. This can be an expensive way to get liquidity. The next thing on this list is invoice factoring. Invoice factoring is when you have a bunch of outstanding invoices and you go to a company, an invoice factoring company, and this company says, okay, well, I'll pay you 80 cents on the dollar for your invoices. So maybe you have $10,000 of invoices outstanding, they pay you $8,000, and then you're done. They own the invoices, and then they have to then go and collect on them. This is a very expensive way to get liquidity in the door. And it's also typically a sign of a business that has potentially has cash flow problems. So you want to be aware of that if you then think you're going to have to go out to a lender or potentially a partner or an investor. You want to be aware of the fact that this is not typically something that a business that has a healthy cash flow is doing. And then finally, on the end of this list is credit card merchant advance. So the way this works is this works really well for a company that has a lot of credit card receivables, like a restaurant or something, or any company that has a lot of credit card receivables. And the way this works is that you take a loan, you get some liquidity straight in the door from this company, this credit card merchant advance company. Let's say they pay you $10,000, you borrow $10,000, and then you pay that loan back over time from your credit card receivables. So let's say you say to this company, I'll give you 10% of everything that comes on into my business from a credit card, it goes straight to your company. And that goes towards paying off the loan. And so if you have a cyclical business and you have a lot of revenue in the summer and not so much in the winter, it's okay because it's still 10%, no matter where you're going. And so again, a pretty expensive way to bring liquidity into your company. These can seem and sound like great ideas. They are considered to be some very, very, I know I keep repeating myself, but I want to be super clear about this. They're expensive. Does anybody have any questions on these? And again, we can chat later on or at the end, of course, also. Okay. I can't help but repeat myself over and over and over again. I just want to be really clear. These two things are things we should all be doing. We have now reached, meaning getting money in the door as quickly as possible, having as much flexibility on the back end. We have now reached the point where things are starting to look and get potentially expensive and can be damaging to potentially to your credit score or your business reputation in whatever way. So you want to be really, really aware of that. These are expensive ways to bring in liquidity. Okay, I know, I'm done, I promise. Okay, so now here we are at borrowing and credit. And so let's just talk about what really this means. And I want to just show you visually the difference between borrowing and credit. So we want to make sure that we have enough liquidity in our business. Again, no matter what your business is, you will have something on this spectrum of speakers on this PowerPoint presentation. You'll either have tons of cash or you'll have tons of assets or something in between. And different things work for lots and lots of different companies. But what does it mean to be able to borrow or have a letter of credit? So borrowing, again, just visually, is when somebody actually pours water into your beaker. They're saying, you need some money? Here you go. Take this money, do with it what you wish. If it's an equipment loan, it'll have to be something based on your equipment. If it's a specific loan, of course, you'll have to meet those requirements. But for the most part, when you borrow money, someone is just pouring money into your beaker. And then, of course, you have to pay it back. When you have credit, you have your beaker and it's full of water or ice cubes or whatever it is, but you have this huge water tank behind you. And so you can go up to the faucet and take some water and use that water or liquidity for whatever you need it for, and then you could pay it back into the water tank. And then you can take some more water if you need to a few months later and then pay that back. And so the way a letter of credit or a credit facility works is typically, if it's a revolving credit facility, it allows you to take funds, pay them back. While you haven't taken any funds, typically you won't be paying any fees or any interest. When you have money, let's say you take a $10,000 line draw down on your credit facility, you would be paying interest and maybe perhaps fees, depending on what your facility looks like. And so that's how borrowing differs from credit. There are lots of different ways, of course. I told you I was going to hammer you with lots of information. There's lots of different ways to do this. If you borrow, you can go to a traditional bank and you could apply for a loan, and the bank may or may not give you the loan. loans typically from banks are sometimes have lower interest rates. Of course, that depends on your credit score, but they can be quite complex and time consuming to get. So if you need to get a loan straight away, going to a bank may be a difficult road to go down. It may not if you have a good banking relationship, but they can be time consuming and they can be less immediate than other types of liquidity. Another way you can get a loan is through the SBA. I'm sure you're all familiar with the Small Business Administration or Association, whatever it is. So these are government-backed loans that the SBA offers. So the SBA is a government agency, and they back loans that are offered to small businesses through banks that they have relationships with. So the SBA doesn't actually offer loans. So these can be really good because you may be able to get an SBA loan even if you have no assets or revenue. So these are good for businesses that are just starting out without a lot of credibility perhaps behind them. Maybe it's just an idea in your head, which is great. But on the con side of SBA loans, they typically, I haven't taken one out, but from everything that I've read, they require mountains of paperwork. They can require very strong credit, a strong credit score, and they can sometimes require a personal guarantee. So they're a great deal because part of them, or potentially all of them, can be backed by the government, which is a terrific deal, but they can be difficult to actually get from my experience, from what I've researched and read. I don't have any specific experience in that department. So now let's say you don't want to go necessarily to a bank, a traditional bank. You may want to consider a non-bank loan or an alternative type of financing, some other type of non-bank entity that's willing to lend you money. So this can be quite simple. It can be immediate or fairly quick. And sometimes they don't even check or care about your credit score, which is terrific. But on the other hand, on the con side of that, because of all of those things, because they can be immediate, they might not check your credit score, they can have quite high interest rates. So you do want to be aware of those. And you'll see in all the tiny little print at the bottom, it can have interest rates of 29.99% or something, with a chance of it increasing or something. You really, really want to read the small print when it comes to any loan, of course, any type of financing or liquidity option. And then finally, letters of credit. So you can really think of this literally as like having a credit card for your business. That's what credit is, a credit card. You can charge on it, and then you can pay it back, should pay it back, and then you can charge on it again, and then you can pay it back. And so having a credit facility it's just like having a credit card. It can be revolving, which is great because again, you can draw on it, pay it back, draw on it again, pay it back. It can actually help your credit score. Having a facility like this will help your credit score. But again, with most typical regular credit cards, they can have high fees and interest rates if you don't read the small print or if you don't have great credit or whatever. So any questions on borrowing and credit before we move on to, what are we moving on to? Oh, the final thing, investors. Okay. So this is a quick one because it is completely, of course, adding liquidity to your business if you bring in an equity partner, an angel investor, a venture capital firm. But this is kind of a talk in and of itself and isn't really, in my opinion, what we're here to talk about today. So I just want to talk a little bit about some of the pros and the cons of bringing in investors. Some of the pros are that they're, unlike a credit facility or borrowing, there's no interest payments, there's no financing fees, they just plunk money into your business. I mean, it's not that simple, but they just give you money and you don't have to pay it back. You don't have to pay interest or financing fees on it. Again, like the SBA, like we were talking about, sometimes investors don't even need assets or revenue. They are happy potentially to just invest with an idea. And that would be great because it helps you have some liquidity in straight away so you can actually start building your business rather than waiting to save all of that money or creep along and bootstrap it by making money and investing in your business that way. So this is can potentially be a pretty quick way to solve cash flow problems. Those are the pros. some of the pros. Some of the cons are that investors can expect hefty returns. They can expect a lot. They can be looking for hefty returns. Meaning the actual people could come in and challenge your business ideas or your decision making. And here we are at the very, very bottom of our list. And this is why they are the most expensive, is because you have this amazing business that you are killing yourself, I'm assuming, to build. I've been there. And they are going to take a portion of it. You're giving them a portion of it. For this liquidity, you're saying, take a percentage of my business and all of the revenues that that percentage will earn in the future. And that, my friends, is an expensive proposition. That's why investors is at the bottom of the list. Okay. Oh, so here we are. I just want to, again, reiterate back to our lovely diving board liquidity, diving into the pool example. Those are the 5 tactics. I know there were thousands of things within the 5 tactics that we were talking about. If you have any questions, again, now or later, we can certainly talk about it afterwards. I want to move on to the most important thing you can do to help your business. This is the 3rd section in our talk. And everybody's excited, I know. The most important thing you can do to help your business in the realm of liquidity, in the realm of talking about maintaining and managing liquidity, is being aware of and taking care of your credit score. So there are different types of credit scores. I'm going to do a pretty quick overview of them just to bring everybody up to speed. There's personal and then there's business. Talk a little bit about personal and then a little bit about business. I'm not going to talk too much about this because really what I want to get to is tips, what you need to do in order to make sure you have a business credit score, and some tips that you can use to maintain that and hopefully make it better. So let's talk real quick about personal credit scores. What are they? I know this is probably a review for many of you, but let's just go over it really quickly. So personal credit score is like a measure of whether or not the lender is comfortable lending to you. And it is made up of 5 components, which I'm going to list real quick. So it's made up of 35% of your personal credit score is made up of your payment history. So a lender is going to look at your payment history and say, am I going to get my money back? Can I lend to this person? And does their behavior in the past make it seem like I'm going to get my money back? So that's a big 35% portion of the pie. 30% of your credit score is based on your capacity. And so this is basically how much you have available, like on your credit facility or your credit cards or whatever it is, how much you have available to borrow versus how much you have borrowed. So the capacity that you have, and they also will look at how much you've actually drawn on that. It will also look at your credit history, which is what you've done in the past, how long you've had credit outstanding, different types of credit. So of course you want to keep your credit accounts open for as long as you can. If you have old credit cards, you can cut them up, but don't close the accounts. Lenders will look at your credit history. And then the last 2 things, which are both 10%, is types of credit used. So they want to see, have you had student loans? Have you had a mortgage? Have you had a car payment? Have you had a personal loan? All sorts of any credit cards, obviously. They'll want to see that you have had different types of credit and you're capable of paying them back. And also past credit applications. It says past credit applications, but really it's recent credit applications. So they're looking to see, have you just applied for a mortgage, student loan, and a car financing in the past month? If so, maybe I'm a little less likely to want to lend to you because it looks like you're trying to take out a lot of debt at one time. So this is your personal credit score. Again, I'm sure this was mostly a review for most people. So your business credit score is different. It's different. And not everybody has a business credit score. You actually have to jump through some hoops in order to make sure that you have them. So the personal credit score companies are different. Some of them are different, but your business credit score companies are Experian and Equifax are the same. They do both, but these are different things, and they are scored in different ways. So personal is something between like 300 and 850, whereas most of the business credit score companies will score you between 0 and 100. The better except for the bottom right, FICO one. The higher your score, the more likely they are to offer you loans at lower interest rates. And so there are 7 milestones you want to be thinking about in order to make sure you have a business credit score. Not everybody has one. You actually have to go out of, not too far out of your way, but you have to go out of your way to make sure that you have a business credit score. The way you would go about doing that is this: an EIN, an employee identification number. This is the same thing as your social security number for your business. And so when somebody wants to go run your personal credit, they run it through your social security number. When somebody's running your business credit score, they will come and look for your EIN. And so if you want to have a business credit score, you must register your business with an EIN. I'm sure many of you have already done that. You then want to establish lines of credit. So you actually have to go to a supplier or some sort of where you buy your inventory or whatever it is that you have a relationship with. And rather than say, I want to buy 50 widgets, here's the money, say, I want to buy 50 widgets, I'll pay you in 30 days. That's a line of credit. You need to have that. Those are the types of things that the credit score agencies are going to look for so that they can judge you on your credit. And some of them will want you to have more than a couple lines of credit, 3 or 4 or 4+. So you need to actually establish lines of credit. Not surprisingly, you then want to pay your payments on time. Hello. Ideally, remember back we were talking about the balance sheet and the net income was at the bottom and it was a snapshot in time. Ideally, you want your annual net income to cover your debt obligations. So you want to be using money that you're making to cover these debt obligations rather than dipping into savings or borrowing to cover them or taking it from investors. So you want to be able to demonstrate that. You want to make sure that you request your report. And I think the next thing is, well, number 7 is fix any mistakes. You want to request your report at least, I don't know, whatever works for you, once a year, once a quarter, whatever you're comfortable with. You want to track it. You want to do it again every quarter or every year and make sure that you're on top of your credit, your business credit score, so that you can fix any mistakes that come up, and they come up. Okay, and finally, let's talk about some tips to improve your business credit score. I had some notes for this. Where did I put them? Oh, well. So you want to establish lines of credit with your vendors and your suppliers. That's pretty important because if you don't do that, they won't report to the credit agencies. So you actually want to establish lines of credit and then say, hey, who do you report to? And you want them to report to the same agency so that agency can actually track your credit. And you want to make sure that they're actually reporting. Obviously, you want to make sure you make timely payments. You want to, again, make sure you're covering your debt payments with net income, ideally, if that's at all possible. Maybe harder in the beginning than it is if you're 5 or 10 years in, but that's something you want to strive for. You want to make sure you're tracking your credit, your business credit score, and fix any mistakes that come up on your credit report. You want to, this is kind of the, not tricky, but this is the clever thing to do. You want to strive to use credit in a low risk way. What does that mean? It means you want to set up a recurring payment. You want to actually use credit. You want to use your capacity, you have your capacity, you want to use a little bit of it and pay it back. Use a little bit of it and pay it back. Use a lot of it and pay it back. Use a little bit of it and pay it back. You want to actually use credit in a way that shows lenders or the credit reporting agencies that you are a really good, responsible borrower. And if that means that you set up a 30 or a 60-day line of credit and you just use it and pay it back as a matter of course, even though you might have the cash on hand, that's a really good way to increase your credit score. And then finally, just like in with a normal credit card or our personal credit scores, you don't want to close accounts. Long-standing accounts are looked upon very favorably by lenders. So here we are. That is the end. I told you that I was going to hammer you with a lot of information. And if anybody has any questions at all about anything that we talked about, please feel free to either take yourself off of mute, pop it in the chat, Please feel free to LinkedIn connect me, Casey Halliley. My last name is Halliley. Feel free to email me, anything at all. Being in a room, even if it's virtual, with a bunch of women entrepreneurs brings me so much joy. And I'm so thankful that you came and listened today. I invite you to check out the other talks that we have on the ODU Women's Business Center YouTube page. And of course, join us on Wednesday, April 28th for our last talk.
Thank you, Casey. That was a wonderful presentation. And please, everybody, surveys have been sent to you. So, and that'll come through Constant Contact. So please reply to those. That helps us with our funding to bring programs like this to you in the future. So please reply to that. It would be greatly appreciated. Thank you so much.